Based on its financial metrics, Mastercard is one of the highest quality businesses listed in the public markets. But their business model is very sensitive to changes in consumer spending, and to date its performance remains strong in an economy which is becoming increasingly more and more turbulent. And as you can see here, year to date they are up 4.3%, trading around $361, and over the last year they are roughly the same, up 4.6%. In this video, I want to take a closer look at the dividend stats and the valuation of Mastercard. So if we jump into our stock screener, we can pretty much see everything auto-populate relatively quickly. You can see the PE non-GAAP 4 ratio is around 25, which is actually lower than the usual around 30. The dividend yield is around 0.6%. The payout ratio is just 19%. So this is a very, very high dividend growth company. The 52-week high is 390, and the analyst target price is actually a bit higher at $426. The EPS growth above 10% sits around 18, and the return on equity above 15% is a staggering 153%. But let's jump into the dividend data tab to take a closer look at the metrics behind Mastercard. And as you can see here, the dividend growth rate over the last 10 years is annualized at 26%. Obviously, we had the starting numbers here of 109%, which is extremely high. But over the last couple of years, we do see really high growth rate as well. 30%, 20%, 10%, 14, 16, and so on. So it's a really, really high dividend growing company. If we scroll down to the dividend yield graphs here, you can see according to dividend yield theory, there is a 13% discount. And as you can see here, it has actually been undervalued for quite some time, at least according to dividend yield theory. Whenever we are in the blue area, it indicates that it could be undervalued, and wherever we move below the line for the red area, it could indicate that it is overvalued. And if you scroll down a bit here, you can see compared to the S&P 500, it's actually massively outperformed it. So this is a very high quality stock as mentioned in the intro. But we also do want to take a closer look at the intrinsic value of Mastercard. So if we look here at Graham's revised valuation model, we do take the EPS of Mastercard, combine it with the PE of a North Korean company, the growth rate of around 20% forward going from Mastercard, the average yield of AAA corporate bonds, combined with the current yield of AAA corporate bonds, we arrive at an intrinsic value of $260 roughly. Next one is the discounted cash flow model, where we have the free cash flow from the different years. Summarize all these together, we arrive at an average growth rate using an applied growth rate of 10%. We can then project the future free cash flow using a discount rate of 9%. We can then find the present value of future free cash flow. We sum all those together, combined it with the cash and cash equivalents, the total debt on the shares outstanding, we arrive at a fair value of $260. The next one is the dividend discount model, and as you can see here, intrinsic value is negative, and that's simply because the growth rate of the dividend is so high compared to the weighted average cost of capital that the model fails to calculate a correct intrinsic value. Next up is the multiples evaluation, where we do compare Mastercard to some of its peers such as Visa and so on, and some of them are blanking out due to the negative EPS. We take the median multiple of those companies, combine it with the EPS from Mastercard, and then we arrive at a stock price of $325. Next one is the free cash flow valuation, where we take the price to free cash flow from the different years, combining all that an average of the price to free cash flow ratio, combining it with the free cash flow per share, we then arrive at an intrinsic value of $360. Last one is the Peter Lynch model, where we have the growth rate, the dividend yield, the PE ratio from Mastercard. Combining all those together, we have an intrinsic value of $291. Before we jump into the summary, thank you so much for watching, and if you've come so far, please subscribe to the channel and like the video. Let's jump into the summary, where we have our different valuation models. I have excluded the dividend discount as we saw it had a negative intrinsic value, so we cannot use it of course. It arrives at an average intrinsic value of around $300. With the current price being of $361, it could indicate that there is a premium of around 21% at the current time. I personally think the current price seems excessively inflated relative to the fundamentals, and investors should probably be braced for any correction going forward. That being said, I think Mastercard is an excellent company. They have very strong financials. I would love to own the company, but not at the current valuation. So if we put in a margin of safety of, let's say, 10%, we arrive at an acceptable buy price of $267. Obviously, that is a $100 drop. Can that happen? Yes, it can. If we go back here and look at the 52-week low, it was actually $276. So just around half a year ago, we actually were very, very close to this acceptable buy price. So even if we just remove the margin of safety, we were actually in that, or just apply a margin of safety of, let's say, 10%, we were actually pretty much on point, the target back 6 months ago. Thank you so much for watching, and I'll be seeing you in the next video.